METACO Talks. I'm Seamus Donoghue, the VP of Strategic Alliances at METACO. If this is your first time joining, METACO Talks is a bi-weekly discussion with thought leaders from the industry. And today our topic is bringing the old and new worlds of asset custody together. And I'm very happy to have Swen Werner here to speak with us. And for those that didn't catch the live streaming or aren't able to list all of it, this will be available as recordings on most of your favorite podcast channels, as well as YouTube. So let's dive into it. Welcome, Swen.
Good morning, and thank you for the invite. It's really excited to be here.
Great to have you here. I mean, I think we speak to many kind of large tier one firms like yourselves, but I think you have a much deeper kind of background in this space, having been in the space since 2018, and obviously at a very large institution that's announcing moves in the space. We'd love to hear, your background and how you got into this, and where you are now, basically.
Yeah, I think that's a good question, and it was obviously when I was at university, could not study Bitcoin and crypto back then. So it was a very organic transition into this. Actually, it started already in, I would say, a few years earlier. So at that time, I was working with a number of central banks on their market infrastructure strategies, how they evolve, RTGS systems, etc. And then this thing came around called stablecoin, and the question really posed by some central bankers was, well, what would that do to our, the way we process euros or sterling or US dollar, and how should we think about our long-term strategy? So I was writing some papers and some analysis, and that was also the time when the conversation started around a project called Utility Settlement Coin, which is now Finality. Because remember, at that time, nobody had heard the term CBDC. I think that's also just a couple of years old as a term. And so that work basically then got me hooked. And then, as you said, in 2018, I started working full-time on digital assets and blockchain, and have been doing so ever since.
Interesting. I mean, many people thought the industry was finished after 2018, so it's great to see you persevered, as did State Street, basically. So, I mean, one of the themes we all, given your, I mean, there's very few firms as large as State Street, particularly in the global custody space. How hard has it been to innovate in that space? Because obviously, digital assets is something very new and fast evolving.
Yeah. I mean, I spent my entire career at large global organizations, that have a workforce of the size of a mid-sized city. So in a way, I think it has there's a reason for size in terms of the scalability it gives you, and but it is hard. I wouldn't say it's we are. We can't prove that we do a lot of change. Actually, if I look at our applications, we're making over 3,000 IT changes to our various systems per month. So this is, you have constantly, you have to adapt and then change to requirements. I think when it comes to digital, there's something very different now, which is the change is much faster. So traditionally, you could neatly plan this, and now new requirements popping up all the time, and basically our delivery has to be even more agile than if you want the traditional management methodology means. Then the other thing which makes a change, particularly for big organizations, is that the risk that these new assets entail is somewhat hard to measure, or there's no real best practice. You could, if you think about different custody models, is it cold, is it hot, what's the optimal model? And so the regulation is still evolving in this. And then I would say finally, fintechs also have a different economic model, how they're funded, how they're looking at basically winning new business, and then how long they can sustain negative cash flows. So taking this all together, you're moving faster, you have more uncertainty, and you're dealing with a new breed of competitors, obviously makes it quite hard. But that's actually also one of the reasons why we proactively want to partner everything we do now in State Street Digital. The new division we have around the digital assets is really trying to be open architecture. So we need to embrace it. We need to work with organizations like yourself that bring these new kind of technologies to the forefront.
So you brought up State Street Digital. I mean, obviously, the market has recently heard the announcement of this new launch. What is it? And is this part of the idea you talk about partnering? Is that a different ethos? Does that require kind of a separate sort of division to let's say to innovate faster than the bank otherwise would?
Yeah, it's its purpose. It's real if you want an investment into the future. So we have been And, I'm a good example of that. So we've had various activities within the bank looking at digital assets and blockchain, but they were driven out of basically the existing business divisions, either our global markets business or custody or what have you. And if you look at our product portfolios, depending how you measure this, but I would say so maybe we have 100 sort of core product groups and activities that we provide to clients. And so what you have to look at is how would these products transition into the future, but also which new ones do I need, which ones probably I won't need in the future. And that requires a different level of focus. So it can no longer be, you do custody during the day and then you have a moonlight job, which is figure out digital. You have to have, dedicated workforce that lives and breathes for these things. And that's really what State Street Digital is about. We want to build a service model that moves away, if you want, from the traditional intermediary record-keeping business towards more of that you're orchestrating, data, you're orchestrating a network of fintechs and bring it together. So there've been announcements made in the past, for instance, that we provide trading technologies for digital asset platforms. So all of these activities are now coming together into one group under one single leadership, and that hopefully will give us the focus needed to make sure that we can adopt to that change and also then help clients to transition it. Because think about it in State Street, most of our clients obviously are heavily invested in traditional assets and is starting to add crypto assets. And so we need to, digital assets more broadly, and we need to bring this together and have a seamless service around that.
Very interesting. So, I mean, given that you've announced this new division, is this a statement to the market that for security services, every major security services firm is, let's say, table stakes needs a digital asset offering now? Is this what we're seeing from the market?
I would think so. So for me, and I think that's shared by a lot of decision makers in that space, as the digital is a very pervasive technology. So you can. Maybe some few years ago, you had this debate of, is it really coming? Is the technology ready? So that is no longer really debate. It's like it will become an existential question for not just custodians, asset managers, everyone in the broader financial ecosystems. And so therefore, you have to have a credible blockchain and digital asset strategy. Now, then the other question is like, again, if we're looking at crypto custody, which is sort of a very hot topic these days. And now, last time I counted, 70 or 80 different providers all across the globe. Can the market sustain all of that? I don't know, but you have to realize that there is now a demand for these kind of services. And if you want to stay relevant as an organization, I think you have to jump on the bandwagon and develop a service. Absolutely, I would say it becomes an imperative now.
I mean, that demand question, I guess also the competitive pressures to move as well. So what does a traditional legacy custodian need to do to embrace this new world then?
So I think two things. So sometimes it's very boring and you will hear this all the time, but it is nevertheless true. Regulation. And also sometimes we have these conversations. So what exactly do you mean by this? So do I want a new digital asset custody law? I don't know if that's what I mean by this, but in terms of more certainty of what is permissible and what is not permissible, particularly when it comes to crypto. And you may have seen the recent proposal by the Boerse regulator around the potential treatment of crypto, which is obviously quite a disincentive for large banking organizations to potentially hold these assets in future. So there's it needs to be clarified. Then the whole question around if you were to provide, for instance, crypto safekeeping or crypto administration services, is this a service that requires a license? Certain jurisdictions say yes, other jurisdictions say no. And then the whole integration between, if you want, the traditional asset management regulation and new crypto regulation. So particularly in Europe, we, for UCITS funds and alternative investment funds, they usually require a depository, which on the one hand side safekeeps these assets, but also provides a control and risk framework over that. And there's very little regulatory guidance in terms of how you would perform these services. So it's very important for large organizations like ourselves do we get some clarity of basically what is expected in order to be in regulatory compliance for providing these kind of services. The other thing I would just add on this is, particularly when it comes to tokenized assets, security tokens, this kind of stuff. So personally, I'm extremely excited about this. But we are in the early days of that adoption. So it's really, you can call this chicken egg problem or whatever it is, but it's the question of when do we see these distribution success of tokenized securities or other financial instruments into the portfolios of asset managers. So as soon as you see this happening, I think the market will follow relatively quickly. So that's a key requirement. You know what you're supposed to be doing and how, and then it's happening even at a small scale. So if somebody would start, for instance, tokenized funds and things like that, we see these initiatives popping up here and there. I think it will create a halo effect for the market to adopt that relatively quickly.
I mean, the first step to get there is firms like yourselves providing the capability to asset managers to hold these assets. So I think that's, as you said, this chicken, many ways, chicken and egg. I mean, it's interesting, but you mentioned the regulation. I mean, it's funny how the market's reacted in the past few weeks because regulations really come to the fore with whether it's Gary Gensler or other initiatives in the Senate and Congress. And the market, you would have thought, taken this negatively. But I think to your point, what we see from a lot of the large firms is really about clarity and having some regulation guidelines. So regulation very much enables you guys to move. So that's
And maybe just to chat on this also. And it's always, this is a two-edged sword. But if you take, for instance, Japan, they had like already a year, 2 years ago, a relatively prescriptive framework around crypto custody and saying, sort of, I'm paraphrasing, but basically the only model is the cold custody or cold storage. So if you talk to organizations in those markets, basically my preferred model is X because this is what regulators want. If you go to another jurisdiction that doesn't have that level of guidance, obviously it makes it more flexible, but it also creates now a million lots of permutations what a good model would be. And that kind of sometimes certainty, at least at this stage, can be helpful to move forward because you don't have to question yourself, well, what you're supposed to be building, you're building towards a real template.
Absolutely. I mean, it's early days, so guidelines help. We've often seen too many options actually slow firms down in that sense. As institutions like State Street get involved, what scalability seems to be a big thing. I mean, we've seen small firms in this space for a while. Now you have the large firms that bring institutional scale. I mean, how do you address kind of operational scalability in this market?
Yeah, that's definitely an issue. And obviously, not here to advise sort of my competition how to do this, but what we have seen so far, particularly when it comes to crypto from the sort of the asset management side, it's probably a bit more of a buy and hold strategy. But over time, if you had more like intraday trading, then obviously you will have to have hot storage. So that's something that we're thinking about. What the right model is, giving how we could address our various different client segments. I would say one of the issues really is for us, and it's not so much the scalability, but the safety. So the crypto market that at least traditionally had sort of a pre-funded model where you have to hold your positions at various exchanges. That works very well from a retail perspective, but I think if we see the adoption from an institutional framework, we'll need to move away from this a little bit so that, like today, you will have the ability to hold equities or what have you with your custodian bank. You can trade on those positions without moving them out of custody in the first place. And that same concept will have to be adopted by crypto markets as well.
I mean, you touched there a little bit on what your asset management clients are seeing, but what more broadly or more specifically, you touch on what what sort of services are you seeing being demanded by your client base?
There's a real variety, and sometimes I'm surprised myself, thinking, this could not possibly be happening, and then it happens. So, for instance, when we had NFTs, being so discussed in the press, and then we actually had some asset managers seriously contemplating about the possibility to invest in art through an NFT concept. So whether it's going to happen or not, we will have to see. But there's nothing too outlandish at the moment to not even consider. So I think key aspects are security token, particularly in jurisdictions where there's no framework to do that. like in Germany, I think there's a lot of interest for that. There is interest in crypto safekeeping, I would say more from the asset owner space, smaller asset managers. A lot of the European, at least in my experience, pension funds probably want to stay away from crypto for now. But I've heard US pension funds at least to be open-minded. So you will have if you want regionally, a little bit a diversity within the same client segment. And then within the client segment itself, I think sort of the traditional long-only asset managers probably more bullish on security tokens, other financial instruments that come in tokenized form, less so on crypto, and then asset owners. So for instance, in the US, a good example would be endowment funds from universities. They're early adopters, and they act a bit more like a sort of a private wealth franchise, and therefore you see more interest on that. And in Europe, I would say those banks and clients that have a larger sort of private wealth franchise behind them also are more open to crypto investments, because that's what the underlying clients asking for.
Do you think those firms that are comfortable with the crypto exposure, is this very narrowly defined crypto? Is it Bitcoin or is it Ethereum? I mean, there's so many new protocols, new layer 2, layer 1s. How do you think they're looking at that?
Yeah. So I think in terms of the absolute market, absolutely, this is probably Bitcoin and Ether. Although in the conversations I had so far, very quickly you come into a discussion of what else could you do? Is it Polkadot? Is it what have you? So we're probably not talking about hundreds of altcoins, but maybe tens. I think sort of that increasingly will definitely be in scope. In particular, also I would say this is another key aspect for me, how traditional custody and crypto custody more broadly differs. It's no longer a standalone function. It's very closely tied to trading, liquidity provisioning, as well as DeFi. And if you're looking at DeFi, then per definition, you want to have, DeFi protocols in there. You want to have stablecoin. You want to at least have Ethereum-based instruments there as well. So that's why there's a natural need to not just like look at Bitcoin, but some of these other instruments as well.
I mean, the Bitcoin space seems to be well populated now. We saw announcements, I think, past couple of days of two large banks offering potentially unit trusts around Bitcoin. But we hear more and more about Ethereum, and as you say, the banks at least looking at DeFi. How do you see banks will approach DeFi, given all the decentralized nature of this, of the DeFi protocols?
I am personally intrigued by it. Obviously today DeFi is very much a crypto play. So the question is, could you adopt the concept of DeFi to security tokens? And conceptually, obviously you could, but then you bring a lot of regulation, because suddenly you're dealing with regulated financial instruments. So in a way, can the protocols today and the players in that space today, can they take what they have that works well for crypto and adopt it for security tokens? I would put, at least for now, a bigger question mark to it. The other thing I would also say is the idea that the institutional investor is indifferent to the counterparty risk and just say, I trust in code and I trust in the collateral is probably a bit too premature. Take security lending today. We are a large security lender, so asset managers or lend securities with brokers. There is, all of these transactions are fully collateralized, but typically an agency lender provides an indemnity in case something goes wrong. And so the institutional space is sort of used to sort of a double protection. And now you're saying you're stopping that, and you're moving to, could be perceived as a less safe model. So I think there's still a role for somebody to take some form of policing and additional insurance methodology, even if you were to use DeFi protocols for security tokens. But obviously that's my assumption as of today. If you ask me 2 years' time again, I may have to change, but that's my hypothesis for the moment.
No question, 2 years is a very long time in this market. So, I mean, based on that view, does a centralized deployment undermine the whole value proposition of what crypto brings in terms of its decentralized infrastructure? How do you balance those?
Yeah, So yes and also. So I'm in terms of this is where we're coming back to regulation. We will need to allow the rise of decentralized market infrastructure. So the idea, particularly in Europe, that we have right now, you have CSDR that requires if you issue security tokens that they have to be issued into a CSD, which really means that if you want to tokenize anything that's traded on the exchange, you can't unless you are a CSD. I think long term that is something has to give there to allow more decentralization. But on the other side, if I look at a lot of the initiatives that are being set up right now, I think the market is surprisingly centralized in its deployment. And that's just a quick question of, is everyone ready? So if you had made the experiment a few times where we may be in a POC to tokenize something, but then are all of these other counterparties that are involved ready at the right time to manage a wallet, receive these tokens? So that's always holding you back. But there is, I think, irrespective of blockchain, there's a lot to learn. And some of the important aspects, for instance, with decentralized networks comes the need to operate in trustless networks. And we're seeing this also that concept when we now today deploy internal applications, the markets are already adopting that concept to say you have trustless access to these various applications, and therefore increasing the resiliency of your operational framework. So sometimes it's important to get away from the blockchain, not blockchain. It's what are some of the common themes, and they will apply, I think, whether we're talking about digital assets or we're talking about traditional databases that may be deployed.
I mean, I think it's a very good approach to it. I'd be interested to get your take on, we're talking about the regulation and some of the concerns around this decentralized infrastructure lacks existing sort of regulatory framework. Do you think there's room as well for regulations to evolve? I mean, we've seen basically, I think it was Hester Pierce came out in the past couple of days talking about a lot of the security rules, for example, were set up prior to computers existing, and there's been a lot of evolution in how we look at things since a lot of the existing regs have been put in place. Do we expect to see some evolution there or movement as well?
So I think it's a real challenge. Somebody said this, which I quite like, that we use the 19th century legal constructs with 20th century technology
exactly.
to solve 21st century problems or something like that. It is not a new problem. So in most jurisdictions, security law is 100 years old. Yeah. And even if you today do electronic settlement, you're operating legally in a fictitious world to assume that these electronic bookings in some way resemble the physical exchange of instrument when there are actually no physical instruments anymore. And every time there was a Hague Convention, it has been tried many, many times to, on one side, harmonize this and make these law changes more modern. What some jurisdictions have now done in Switzerland, Germany, is to say, I leave my sort of case law from 100 years because it works, and I'm creating something new on the side to create a new form of digital assets. And that will receive similar protection as the old one, but basically you start from scratch. I think that is more likely to work, but something has to move on that side. Absolutely, I agree with that. And I see the readiness to this. There's an intense interest to make sure, how can we adopt our legal infrastructure to make sure we cater for new and different consumer requirements. But I just don't think it's that easy to say, think around a little bit with securities law and you're done. This would be, from previous experience, quite hard, and also could not be done within a short time frame. So you're looking at a 10-year reform project, and by the time we may have moved on and be interested in other things.
New challenges. Well, we're looking forward to when there's some more clarity on kind of decentralized regs. And what do you see as the role for a custodian in a peer-to-peer network?
Yeah, so I think it's a peer-to-peer is a fantastic theme. Actually, at State Street, we rolled out peer-to-peer repo and peer-to-peer securities finance. So the fact that distributed ledger technology or digital assets, if you want to accelerate the trend to peer-to-peer, is a in a way, an interesting and welcomed development. So you will, at least how we think about today, you still need a custodian to enforce a level of common rules and making sure that if something goes wrong, that the investors are protected. I mentioned earlier already in DeFi protocols, the need, for instance, to provide additional indemnities. And that is something that I think could continue in future. There's also an aspect of counterparty risk selection. So we have a lot of institutional investors will obviously say, I will have certain minimum requirements who I'm trading with, and are they being enforced? And again, the custodian can help to make sure there's a pre-selection and there's certain entry barriers. So this whole idea that you go to an extreme world of peer-to-peer where everyone can play, I think in the regulated securities industry probably will take much more thinking before this becomes a reality.
It's interesting. You're already making steps in the peer-to-peer trading on the areas you've just mentioned. That's fascinating. So you're already gaining experience around how to adhere to kind of existing regs in that context. Stepping back and looking at bigger picture, where do you see the biggest gains and efficiencies and markets from digital asset adoption?
Yeah. So for me, well, it depends. This is always an interesting debate, and you will hear everyone saying about faster settlement and no reconciliation. These are all valid, interesting points. I'm personally interested in 2 or 3 things. So one is that distribution could become a digital. So if you had a digital fund, a digital cash, you can basically buy directly from your asset manager for whoever you're investing in and hold these assets in your own wallets. Maybe that's more of a retail play initially, but it's a different way of conducting business. You no longer have to go through a chain of intermediaries. But also for institutional investors, it potentially brings better data about distribution. So asset managers are always very interested to say, who is buying my funds, why, and can I track this in real time? If you had a tokenized instrument, you could very quickly see, in certain jurisdictions, people want to buy ETFs investing in car companies versus something else. And that would allow the asset management industry to react much more appropriately to changes in investor demand. Then the other thing is around particular digital cash offering new forms of digital money. And here I like this idea of, particularly with stablecoin, it deconstructs the instrument. Today you have a cash account, you can pay from your cash account, and you also earn interest from that because your bank is investing that money. With a stablecoin, you can take this apart. And these are 2 different decisions. I can have the stablecoin to pay, but the collateral that's backing it up and earning the interest could sit anywhere else. So this is a level of deconstructing the value chain that is not possible with traditional payment forms. And I don't think we have seen the end of innovation that this could bring. And then related to this, obviously, is the programmability of assets. So you can have a certain, basically a self-enforcing asset. That is something that, again, in traditional setups is not possible. And I would think there would be some very creative planning and inventions coming from that side. So for me, these are the interesting things, not so much about, which is important, efficiency gains. It's really, you can build new asset types and therefore build new business models potentially with them.
I think that's an exciting future, and it's great to hear that we've got people like you inside organizations like State Street thinking about this future, because that's definitely extremely dynamic and will be exciting. I think unfortunately, the time has flown by, and it's been great to have you here. I mean, if people want to reach out and connect with you, what's the best way to do that?
Yeah, find me on LinkedIn. I think I'm quite active there, so drop me a note. Always happy to chat, and also hearing feedback. I think one of the interesting aspects, particularly in this digital industry, is this: the network is so much broader, and people bringing so much interesting aspects. I think we all have to learn both from the traditional security services side, as well as a number of new players that bring a fresh and interesting perspective.
Absolutely. Thanks, Sven, for joining us today. Thanks, everyone, for joining. As mentioned, the recordings will be available on your favorite podcast channel and YouTube. Join us again in 2 weeks, and thanks for joining today. See you next time.
Thank you.